We are now going to move on in this chapter to cost flow assumptions. And what does this mean? Um, this means that when we value our inventory, we have to make certain assumptions about the compilation of what may be in our current stock. It would be very easy if the first day of our accounting period, we went in, we bought up all our inventory, we didn't have any left over from the prior accounting period, we just bought one batch of inventory, and then we sold it all before the last day of the accounting period. That would make things incredibly simple, but it's never that simple. We generally have inventory left over from a prior period. The price that we pay for inventory is likely to change every time we make a new order, either up or down, depending on the kind of industry and the economic factors. And so when we're staring at our warehouse with inventory in it, we have to make a determination about, especially if we're looking at identical products, if we have cans of soup or something where they all look the same, there's no physical difference from one item to another. How do we know what we sold? If we bought a batch on Monday and on Tuesday and on Wednesday and we just tossed it all in the warehouse, how do we know what we sold of those batches? And why do we care? And the short answer is we care because we paid different prices for them potentially if we bought them in different batches. And that will determine what we paid for them. Our cost of goods sold will be based on what we paid for the items that we sold. Now, this is, for the most part, a theoretical exercise. It often doesn't have any actual link to the physical batches and the order in which each item is sold, or we don't often track things down to the individual item level. We are just, to the extent that the items are similar and fairly generic, whether something got delivered in our warehouse yesterday and looks exactly like what got delivered in our warehouse last week, we're not going to split hairs over if they were both placed on the shelf, which one the customer pulled off the shelf and decided to purchase. However, the cost associated with that item will depend on which one of the valuation methods that we choose. And so we've got four basically that we're looking at. We're looking at what's called specific identification, where in fact we do track each individual item, but those are generally fairly large, unique things. You could have artwork in a gallery, for example, where you've got custom pieces, or a consignment dealer with classic automobiles. And so you would have very distinguishing features about each separate item and probably very different costs associated with them. And so you would want to track those specific items individually and not kind of as in batches. And then, so then we've got the first in, first out, which operates on an assumption that the items that we purchased first are the items we sold first. In other words, the items that were in our inventory at the end, they were left over from the last accounting period. It's what we started this accounting period with. There's an assumption under first in, first out that what gets sold first is the items that were in our starting inventory at the beginning of the period. Then there's the average cost method, and that, like it says, does an averaging, and there's a couple of methods we'll talk about. And then there's the LIFO method, which is the opposite of the FIFO method. The LIFO method is last in, first out. So there's an assumption that the stuff we purchased most recently is the item that the customer took off the shelf and bought today. So this is just a graphic that describes basically the difference in how, as an individual unit, it might flow through our physical control versus the costs for the units and how the costs will flow through through our system. So we will have units that we start our accounting period with, and then we'll quite likely buy some more during the period. And between what we started with and the additional items we bought, those comprise our units available for sale. Sorry about that. Okay, so now we get to our the end of our accounting period. And of the units we had available to sell during that period, we need to determine what we sold versus what's still in our inventory at the end of the period. The stuff we sold flows through to the income statement in terms of the costs, and we'll talk about what form that is in a second. The units that we still have that are in our ending inventory will show up on our balance sheet under the asset section. And that's kind of the flow of items. From a cost standpoint, we have our beginning inventory value, and then the cost of what we buy or produce, and those go into our cost of goods available for sale. The costs of what we could potentially have sold during the period. When we get to the end of the period, we look at what we sold versus what we still have. What we sold goes into the cost of goods sold on the income statement. So when we compare this to units sold on the income statement, that is in the form of our cost of goods sold. And then our units remaining, that is our cost of ending inventory, which flows to our balance sheet as the asset. And so this is just an example for Dalton Company of the inventory, and I will just laser pointer here. So we've got our inventory at the beginning of the period. We bought 2 more batches of inventory during the period, so we had a total of 250 units that we could have sold. We sold 2 batches during the month for a total of 140 units, and that leaves us with 110 left over of that 250. And now we're just going to, for the sake of argument, assume that all sales were for $20 a unit. And you see here that we paid different prices for each purchase, for our beginning balance as well as each batch that we purchased. But for sales, we're going to assume that we sold them for all the same price, regardless of what we paid for them. So we have sales revenue of $2,800 for the 140 units we bought, or sold during the period. Now, in terms of, and so let me just jump back. So we've got our sales revenue that we can start our income statement with, but we need to then subtract from that the cost that we paid for these 140 items that we sold. Did we sell them out of the $10 batch, the $11 batch, the $12 batch, some out of each, and if so, how many? Because how we make that determination will determine what our then cost of the goods sold was that we're going to subtract from our sales revenue. And so the first method to do that we're going to talk about is the specific identification method. And so here the Dalton Company would specifically identify the units sold on April 27th. And it would literally have tagged each unit, and it would follow each unit specifically through the chain. And so if all the units are from the beginning inventory, Dalton's cost of goods sold are $10 from each unit. However, if they're purchased from either the one or the other or both purchase batches, they're either going to have $11 or $12 in cost depending on where they came from. And so Dalton must literally physically track which item was bought or sold out of which batch. And again, if we're talking about things like boxes of cereal or cans of soup, that is an incredibly laborious task and not something that's done generally with high volume generic type of products. Now we get to FIFO, which stands for first in, first out. And this assumes that the stuff we bought first, we sold first. And so the stuff we paid for initially would be the stuff we sold first, and that would comprise our cost of goods sold. And the stuff that we bought most recently, unless we sold everything, the stuff we bought most recently is going to be what's sitting in our warehouse. And that will contribute to our ending inventory figure, and that's what ends up on our balance sheet. So in our first in, first out analysis with these same sales figures from Dalton Company, we're going to assume now they sold 140 units of the 250 they could have sold. So under the first in, first out analysis, the first ones that they would have sold would have come from the beginning inventory. And they would have sold out of the beginning inventory before they then started taking from the next purchase batch and then the most recent purchase batch. And so in this case, they had, let's see, beginning inventory was, I think, oh, so we have it here. Beginning inventory was 100 units. So of the 140 we sold under the first in, first out method, we're going to assume that we wiped out our beginning inventory first, then we got some from the next set of units, and then we will have exhausted the 140 at that point. So then what's left is the second date purchases that we made, and that's what and part of the first purchase date and all of the second purchase date, and that's what goes into our ending inventory. The average cost has two different ways that we potentially could look at this. And how we look at this, it depends on whether we're using the periodic method or the perpetual method. Remember, the periodic method, we don't track our inventory on a transaction by transaction basis. We just sell without regard for keeping track of how much we're actually selling in terms of units. And then we walk out into our warehouse at the end of the accounting period. We look around and we count up what we have left. We know what we started with. We know how many more we bought. And we subtract what's left at the end. And then the difference is what we must have sold. Not my favorite method, but that's what people do. And if we're going to use that method, then the average costing method is known as the weighted average method. On the other hand, if we're using a perpetual inventory system and we're tracking each unit as we're selling them when they go out the door, then we're going to, every time we purchase a new batch, we're going to recalculate the weighted average. And so this is known as the moving average method. So the weighted average, we do one average calculation. Everything we sell in that period is at that price. Whereas with the perpetual method, every time we purchase new stock in our inventory that's at a different price, we then have to do a new weighted average calculation, and then the stuff that we're selling is at that new cost. And so the calculation for the weighted average is the weighted average cost per unit is the cost of goods available for sale divided by the units. So we look at the total money we paid for the inventory that we could have sold, and then how many units that is, and that gives us our cost per unit. Now we're going to look at so this is the periodic method in graphic form. So we've got our 110 units at $10.88. That's our ending inventory. So we started with 250 units. We sold 140, and we've averaged the cost per unit at $10.88. We spent a total of $2,720 on the products for those 250 units, so that gets us to $10.88 a piece. We have left 110 of them at $10.88, gives us $11.97, and we sold 140 at $10.88, which gives us a cost of goods sold of $1,523. Now we'll look at this using the perpetual method, where we had multiple purchases during the period. So we have our beginning units at $10 a unit. Pretty basic. But now we bought some more units. So now we've got the 100 units that we started with at $10 plus 80 units that we just now bought at $11. So we've got a total of 180 units that we've paid $1,880 for. And when we divide that out, that comes to $10.44.4 per unit, but we'll round for at some point. So now we we're selling 90 of these units at $10.44, so for $940. And so we're not going to, we could continue to sell at this 10.444 cents per unit. And we don't have to do a new weighted average calculation until we buy some more units. So here we are. I wish we had sold a few more dates so you could see that, but anyway, we bought some more units on the 20th. So now we've got 90 units, 90 units left here. This is also a bad example to sell and have left the same number. But anyway, so we have 90 units left at the 10.444 cents. Now we bought 70 more units at $12 for a total of 1,780 for those 160 units. And that comes out to 11.125 per unit. Now we sell some more. And it's going to be at the 11.125 per unit. And we didn't buy any more until the end of the period, before the end of the period, I should say. So we don't have to do any more calculations. And this 11.125 would also be the value of our ending inventory. Now we go to the last in, first out costal assumption under the periodic method. So again, this is going to assume that the stuff that we bought most recently is the stuff that was sold first. Sorry, I had a little change of scenery here. So again, the LIFO method, the stuff that we purchased most recently is the stuff we've sold first. So what's left in our inventory is this stuff that we started our accounting period with. The stuff that's left is our beginning inventory and maybe some of our first sets of purchases, which is what we've got in this case. And I also just want to add that we are looking at this under the periodic method. So because we haven't tracked our inventory on a sale-by-sale basis, and instead we're now standing here at the end of the month looking back through our month of transactions and what we've purchased, we look at it going from the stuff we bought at the end of the accounting period, then the next last, and the next last, all the way until we get to our beginning inventory balance. And so by the time we've knocked through those 140 that we've sold, we've gone backwards in time to see that to get to that 140 going backwards, 10 of it comes from the first purchase that we made in our accounting period, and then the 100 units that were in our beginning inventory are still that's the remaining 100 units to get to the 110 units that we haven't sold because we're going backwards in time. And so you'll see now how that changes when we look at this under the perpetual method, because the perpetual method, we're constantly having to make this analysis because we're looking at our sales in real time. So when we made our first sale on the 18th, unlike the periodic method, we didn't have the benefit of the purchases that had been made on the 20th to go back to first. So we've made our sale on the 18th, and we default immediately backwards to our most recent purchase, which was 80 units, and we sold 90. So we're gonna wipe out the entire 80 units of our first purchase and dip 10 units into our beginning inventory purchase, so that after this transaction, we have 90 units left from what was our beginning inventory. Now we get to the 20th of the month and we've purchased some more units. We bought another 70. So our inventory is 90 of the initial beginning balance units plus the 70 units at $12 a unit. So we have a total inventory value at this point of $1,740. Now we're at the 27th and we're going to make our next sale, and we're going to go to the most recent transaction. So we've got 50 units. Our most recent transaction was 70 units. So we can sell that entire 50 unit sale out of those 70 units, and we still have 20 more units, and we don't even have to touch the remaining 90 units that were in our beginning inventory. So that's what we do here. And so you can see that our inventory balance under the perpetual method, despite the fact that we're using LIFO, between the periodic and the perpetual method, you're going to come out with different numbers even between those two. And I will go backwards so that you can see. So we've got ending inventory on the periodic method of $1,110 and ending inventory on the perpetual method of $1,140, which is obviously going to change our cost of goods sold, because we're going to subtract, we've got our total available that we could have sold, which again is the same regardless of the method we use. We subtract the cost of goods sold, and we come up with our ending inventory of $1,140. And so this is a comparison of the various methods. We don't look at the specific identification method because that's a total wild card. We would have to know with each sale exactly what item was sold to be able to make that comparison. But at least under the 6 methods that we looked at here, we can get a sense of how our gross profit is going to change using each of these methods. And so you can see that, let's see, our highest is the FIFO using the periodic method, and our lowest is the LIFO using the perpetual method. So we'll talk about in a second some of the decision factors that will go into why you might choose one of these methods over the other. Talk about it more in a minute, but I'm going to finish up this video with this slide, and I'll move this up here. So the FIFO method gives us the lowest cost of goods sold and therefore the highest gross profit because it is going to include your lowest costs. It's going to assume that prices are climbing. And for the most part, in most industries, prices do climb. Unless you're in something like technology where things are really expensive at the beginning and then the prices tend to drop, for the most part, most industry prices tend to climb. And so you would also want to know your industry. But when prices are rising, FIFO method is going to give you the lowest cost of goods sold and the gross profit and income that will be the highest. And then the FIFO also produces highest cost of ending inventory because it's going to include the stuff you bought most recently that theoretically you paid more for. The LIFO method gives you the highest cost of goods sold and the lowest gross profit. So you're going to have a lower tax liability theoretically using your LIFO method, assuming prices are going up. And I'm going to stop here because frankly this video is long enough, and I will hop over to the next video for the alternatives of these various cost flow assumptions.